This explosive exposé reveals the Federal Reserve's systematic deception about America's debt crisis and its devastating impact on your savings. The dramatic split-screen visualization shows the Federal Reserve building juxtaposed against a massive debt explosion chart that demonstrates the shocking scale of fiscal irresponsibility. The $39 trillion debt bomb represents the culmination of over a century of monetary manipulation and government spending addiction. The most shocking statistic displayed shows the dollar's 96% collapse in purchasing power since the Federal Reserve's creation in 1913, meaning what cost $1 in 1913 now costs $25 today. This isn't just inflation. This is systematic currency debasement designed to transfer wealth from savers to debtors, primarily the federal government. The warning indicators throughout this analysis demonstrate that we're approaching a critical inflection point where the mathematical impossibility of repaying this debt will force policymakers into desperate measures that will destroy middle-class wealth. This constitutional analysis exposes how government has evolved from limited constitutional scope to controlling over 40% of the entire American economy. The spending breakdown visualization shows the dramatic expansion from the founders' vision of minimal federal involvement to today's massive interventionist state. Defense spending, once the primary federal responsibility, now represents less than 20% of federal outlays, dwarfed by entitlement programs that didn't exist when the Constitution was written. Social Security, Medicare, Medicaid, and other transfer payments consume over 60% of the federal budget, creating permanent constituencies dependent on government spending. Interest payments on the national debt now exceed defense spending, representing over $1 trillion annually that produces no economic value. The historical comparison shows government spending averaged 10 to 15% of GDP throughout most of American history, compared to today's 40%, demonstrating how far we've departed from constitutional governance. This expansion creates economic distortions, reduces private sector efficiency, and establishes the foundation for the debt crisis we face today. This historical analysis examines the 1913 Federal Reserve Act and whether the cure has proven worse than the disease it was meant to solve. The timeline visualization shows the panic of 1907, a severe banking crisis that created political momentum for central banking despite America's successful operation without a central bank for over a century. The original objectives included providing banking system stability, serving as lender of last resort, and maintaining the gold standard's integrity. However, the comparison between pre-Fed and post-Fed economic performance reveals troubling patterns. Before 1913, economic panics were shorter and recovery was faster because markets cleared naturally without government intervention. The Fed's original mandate was strictly limited to banking system stability, not the broad economic management it practices today. The gold standard provided automatic limits on monetary expansion that prevented the systematic currency debasement we've experienced. The founders' concerns about central banking, reflected in Hamilton versus Jefferson debates, proved prescient as the Fed has become exactly the tool of government finance and economic manipulation they feared. This policy analysis examines the Federal Reserve's dual mandate and the tools it uses to manipulate economic outcomes, revealing how these powers exceed what free markets would naturally produce. The dual mandate framework shows price stability targeting 2% inflation alongside maximum employment objectives, creating impossible mathematical constraints that force systematic currency debasement. The policy tools breakdown displays interest rate manipulation, quantitative easing programs, forward guidance communications, and emergency lending facilities that distort natural market pricing mechanisms. The 2% inflation target represents a deliberate policy of currency debasement, reducing purchasing power by over 20% each decade and 50% every generation. Maximum employment interpretation has expanded far beyond the Fed's original banking stability mission, making the central bank responsible for economic outcomes that should result from free market processes. The independence framework analysis shows the inherent contradiction between political independence and Treasury coordination that creates accountability gaps where neither Congress nor markets can effectively constrain Fed actions. This economic philosophy analysis presents the Austrian school's case against central banking and Premium Logic Labs' position that Federal Reserve intervention creates more problems than it solves. The central planning versus free market comparison demonstrates how Fed policies interfere with natural price discovery mechanisms that would otherwise coordinate economic activity efficiently. Austrian economics argues that free market money, historically gold and silver, provides automatic constraints on credit expansion that prevent systematic boom-bust cycles. The moral hazard visualization shows how Fed intervention creates bailout culture, where financial institutions take excessive risks knowing the central bank will prevent failure, distorting normal market discipline. The boom-bust cycle analysis reveals how artificially low interest rates encourage malinvestment in projects that wouldn't be profitable at market-determined rates, creating unsustainable expansions followed by inevitable corrections. Premium Logic Labs' position is that the Fed's existence enables government fiscal irresponsibility by monetizing debt that markets wouldn't voluntarily finance, creating the systematic problems we face today while claiming to provide solutions to problems its own policies create. This comprehensive performance analysis spanning over 110 years demonstrates the Federal Reserve's consistent failure to achieve its stated objectives while creating systematic economic instability. The crisis timeline visualization shows major economic disasters that occurred under Fed management. The 1929 Depression, which lasted longer and was more severe than pre-Fed panics. The 1970 stagflation, which combined inflation with unemployment in ways economic theory said was impossible. The 2008 financial crisis, caused by Fed policies that inflated the housing bubble. And the COVID response that created the largest peacetime monetary expansion in history. The track record shows the Fed has presided over more severe economic volatility than existed before central banking, contradicting its founding justification. The dollar purchasing power analysis demonstrates systematic currency debasement that has destroyed 96% of the dollar's value since 1913, making the Fed the most successful wealth destruction machine in American history. Mission creep analysis shows evolution from limited banking stability functions to economy-wide intervention that exceeds any constitutional or practical justification for central bank authority. This mathematical analysis demonstrates the exponential trajectory of federal debt that makes default or monetization inevitable within the current decade. The debt explosion visualization shows the acceleration from $39 trillion today to Congressional Budget Office projections exceeding $51 trillion by 2030, representing a 40% increase in just 4 years. Interest rate sensitivity analysis reveals the mathematical impossibility. Each 1% increase in average borrowing rates adds $390 billion in annual interest costs, more than the entire defense budget. The deficit sustainability assessment shows current deficits of $1.9 trillion in 2026 growing to $3.1 trillion by 2036, creating a debt spiral where interest payments exceed the government's ability to finance operations. The tipping point analysis identifies when debt service costs will exceed total tax revenue capacity, forcing policymakers to choose between default, massive tax increases that would destroy economic growth, or monetization through Federal Reserve money creation. This analysis demonstrates that current debt trajectory is mathematically unsustainable regardless of economic growth assumptions, making crisis inevitable within this decade. This monetary analysis exposes how quantitative easing functions as hidden taxation that transfers wealth from savers to debtors through systematic currency debasement. The QE mechanics visualization demonstrates how the Federal Reserve creates money electronically to purchase treasury bonds, allowing government spending without corresponding taxation or borrowing from private markets. This process represents taxation without representation because it reduces purchasing power without legislative approval or public understanding. The inflation as debt reduction analysis shows how monetary expansion reduces the real burden of existing debt, while imposing costs on holders of cash, bonds, and fixed-income securities. Historical precedent comparisons with Weimar Republic, Zimbabwe, and Argentina demonstrate that debt monetization always leads to currency collapse and economic devastation. The current warning signs include Federal Reserve balance sheet expansion from $900 billion pre-2008 to over $8 trillion today, with explicit discussions of yield curve control that would completely subordinate monetary policy to fiscal needs. This represents the transition to fiscal dominance where the central bank becomes a direct financing arm of government, destroying monetary credibility and currency stability. This comprehensive scenario matrix evaluates 4 possible paths for resolving America's debt crisis and assesses the political feasibility and economic consequences of each option. Scenario 1 involves austerity measures and tax increases sufficient to close deficits and stabilize debt ratios, requiring spending cuts exceeding $2 trillion annually or tax increases approaching 50% of income, making this politically impossible in a democracy where voters can reject such measures. Scenario 2 depends on economic growth rates exceeding 4 to 5% annually for decades, far above historical averages, and impossible given debt drag effects that reduce productivity. Scenario 3 considers debt restructuring or outright default, which would destroy America's reserve currency status and global financial system, making it economically catastrophic despite being mathematically honest. Scenario 4 examines inflation and monetization as the path of least resistance, allowing gradual debt reduction through currency debasement while maintaining political viability. The probability analysis shows inflation as the most likely outcome because it requires no legislative action, provides immediate fiscal relief, and distributes costs across society in ways that obscure government responsibility while preserving political careers. This crisis timeline analysis identifies the critical period between 2027 and 2030 when mathematical debt dynamics will force a resolution regardless of political preferences. The fiscal crisis visualization shows debt spiral dynamics where interest costs exceed the government's primary budget surplus, creating automatic debt acceleration that compounds exponentially. Trigger mechanisms include bond market revolt, where investors refuse to finance deficits at current rates, forcing much higher borrowing costs that accelerate the spiral. Dollar rejection by international creditors who recognize currency debasement risks would eliminate the exorbitant privilege that allows America to finance deficits through money creation. Credit rating downgrades from remaining AAA agencies would increase borrowing costs and signal institutional recognition of default risks. The critical window timing reflects debt maturity schedules, demographic pressure from baby boomer retirements, and interest rate cycles that will expose fiscal vulnerabilities. International precedent analysis shows similar debt crisis patterns in Greece, Argentina, and Turkey, demonstrating that even sophisticated economies face sudden stops in financing that force immediate fiscal adjustment or currency collapse. This comprehensive impact assessment quantifies how excessive debt reduces economic growth potential and creates a systematic damage across multiple sectors of the economy. The GDP drag analysis shows empirical research demonstrating that debt levels exceeding 90% of GDP reduce annual growth by 1 to 2 percentage points, meaning current debt levels are permanently reducing American living standards. Productivity decline occurs through capital misallocation, where resources flow to government consumption rather than productive private investment, reducing the economy's capacity for innovation and improvement. The generational transfer visualization shows how current spending commitments impose obligations on young Americans who had no voice in creating these debts, representing taxation without representation on a generational scale. Global implications include threats to dollar reserve currency status that would eliminate America's ability to finance deficits through money creation, forcing immediate fiscal adjustment. The systematic economic damage extends beyond fiscal metrics to include reduced business investment, decreased entrepreneurship, and lower employment opportunities as government crowds out private sector activity through taxation and regulation required to service debt obligations. This investment analysis examines how fiscal dominance and debt monetization will create systematic changes in asset class performance and sector rotation patterns. The inflation beneficiaries analysis identifies real assets, commodities, and select equities that maintain value during currency debasement periods, contrasting with value destruction in bonds, fixed income securities, and cash holdings. Sector rotation patterns show movement from growth stocks dependent on low interest rates to value stocks with pricing power and real asset backing. The International Diversification Framework demonstrates why non-dollar assets, and emerging market exposure become essential hedges against currency debasement. Asset class performance during fiscal dominance periods shows real estate, precious metals, energy, and materials outperforming financial assets and long-duration bonds. The analysis includes equity market scenarios where nominal gains mask real losses due to currency debasement, requiring investors to distinguish between nominal returns and real purchasing power preservation. This systematic repricing reflects recognition that government debt levels require either default, which destroys bondholders, or monetization, which destroys currency holders, making real assets the logical refuge for institutional and individual investors. This strategic allocation framework provides specific recommendations for protecting wealth during the transition to fiscal dominance and systematic currency debasement. The asset allocation model recommends 40% real assets, including real estate, commodities, precious metals, and inflation-protected securities that maintain purchasing power during currency debasement periods. International allocation of 30% includes non-dollar assets, emerging market equities, and foreign real estate that provide currency diversification and escape from dollar-denominated risks. Domestic equity allocation of 20% focuses on companies with pricing power, real asset backing, and international revenue streams that can navigate inflationary environments successfully. Cash holdings are limited to 10% for liquidity needs while recognizing that currency debasement makes cash a depreciating asset unsuitable for long-term wealth preservation. The inflation hedges analysis includes Treasury inflation-protected securities, commodity exposure, energy investments, and materials companies that benefit from monetary expansion. Currency diversification strategies include international bonds, foreign exchange holdings, and global real estate investment trusts that reduce dependence on dollar purchasing power. This institutional quality positioning guide provides specific tactical recommendations for navigating the systematic changes that fiscal dominance will create across financial markets. The bond market exit strategy addresses duration risk management and credit risk assessment as government debt monetization destroys fixed income value through interest rate manipulation and currency debasement. Equity positioning focuses on dividend aristocrats with consistent cash flows, inflation-resistant businesses with pricing power, and companies with international diversification that reduces dollar dependency. Real asset accumulation strategies include direct real estate ownership, commodity investments, infrastructure assets, and productive land that maintains value regardless of monetary policy. Alternative investment recommendations include private equity with real asset focus, infrastructure debt, international property, and precious metals that provide portfolio insurance against systematic currency risks. The professional framework emphasizes gradual transition rather than sudden portfolio changes, recognizing that markets may take time to fully reflect fiscal dominance realities while maintaining liquidity for tactical adjustments as conditions evolve. This conclusion synthesizes the complete analysis and provides Premium Logic Lab's final assessment of the inevitable fiscal dominance transition with specific recommendations for individual investors. The historical inevitability analysis shows that every fiat currency system in history has ended in inflation or collapse, with no exceptions, making America's current path predictable despite its unique circumstances. The critical timeline assessment identifies 2027 through 2030 as the decision period when mathematical debt dynamics will force policymakers to choose between default and monetization, with political incentives strongly favoring the inflation path. Investment framework positioning emphasizes real assets over financial assets, international diversification over domestic concentration, and inflation hedges over deflation bets that assume government will choose economic pain over money printing. Premium Logic Lab's conclusion is unequivocal. The Federal Reserve will choose inflation over default because it preserves political careers while distributing costs across society in ways that obscure responsibility. Subscribers should position portfolios now for systematic currency debasement rather than waiting for obvious signals that will come too late for optimal positioning. The channel provides institutional quality analysis for individual investors, helping subscribers understand and navigate the systematic changes that fiscal dominance will create across all asset classes and investment strategies.